What's up, traders, and welcome to this final installment of the Market Barometrix Technical Analysis Series. I'm your host, Neil, and in today's video, we're going to put it all together, man. It's a very exciting day because we're going to look back on all the concepts and techniques that we've discussed over the course of this video series. We're going to put them together in a full rundown example of technical analysis. Particularly, we're going to perform technical analysis on the stock price of Apple. We're going to talk about the prevailing price trend, important areas of support and resistance, the formation of the moving averages and what those are telling us. We're also going to look to MACD and RSI to give us an indication of the short-term price momentum, all in an effort to identify attractive entry or exit points and to evaluate whether it's a good time to get into a new position or to exit existing positions in Apple. So without further ado, let's jump in and do a full rundown technical analysis of Apple. So the first thing I like to do is make note of any obvious trend lines, as those might end up being good places of support and resistance. So jumping out at me on this chart, first and foremost is this longer term trend line. That kind of moves up this direction or so. And you can see that for a long time, this was a line of support, right? So price kept moving up and finding support at this trend line. Then there was a kind of a quick false breakdown before price gapped higher. That was met shortly after with another correction in price that led to this trend line, this area of support getting broken. Since then, price has moved back up, but it's found this same trend line as resistance now. So we can see a perfect example here of a trend line that was formerly support turning into resistance. So this is going to be an important area to keep in mind. We're going to extend this out a little bit. But another obvious place where there's kind of a more recent trend line developing is right here. Looks like we're finding support along this trend line in the more recent price action. So let's keep these two trend lines in the back of our mind as potential areas of support and resistance. So in the interest of keeping our chart clean here and legible, I'm going to go ahead and remove these two trend lines. And let's go ahead and get an idea of the trend along different time frames, the short-term, intermediate term, and long-term trends by way of the moving averages. So the first one being the 9-day exponential moving average. We're also going to add the 50 and 200-day simple moving averages. So we're in the chart here. Again, this is the TradingView technical analysis platform. It's the most robust, comprehensive technical analysis platform out there. So we built it right into the Market Barometer here. Up in the top, you have the indicators button. We're going to give that a click. We're going to scroll down to moving averages. We have the moving average exponential, and moving average weighted. We want to start with a moving average exponential. That's the exponential moving average, the EMA. And when we click that, we see that not only is the 9-day EMA added to the chart here, but we get this little settings button up here. It says EMA 9. That means that we have a 9-period look back. It's looking at close price. So if we click the little eye here, it will hide it or show it again. And clicking the cog wheel here is going to let us adjust the settings. So it says length 9. And if you look up in the top left of the chart here, you can see we're on daily candles, this D here, right? So our length is 9 and we're looking at days. So we're looking at the 9-day EMA. Next, we want to add the 50 and 200-day simple moving averages. So again, we're going to come up to our indicators button, scroll down to moving averages. And this time we're just doing moving average. That's the simple moving average. I'm going to click it twice. You can see we just got two more settings boxes up here, and both of them defaulted to 9. So we need to adjust the settings on these to make one of them 50-day and the other one the 200-day simple moving average. So I'm going to come up to this first one, MA9. I'm going to come over to the cog wheel, and that's going to give me to the settings. Length is 9 right now. Let's change that to 50. We'll say okay. We'll come to this second MA9. We'll hit the settings wheel again. We're going to change this one to 200. And resolution here will allow you to change, the look back period, time frame. It defaulted today because that's the resolution of the chart that we're on. But if you wanted to change it, you can easily through this resolution box here. So I'm just gonna keep it on the same as symbols, so that if we change the time frame of our chart, that these moving averages will adjust with that. So we'll click OK, and there you go. We have our 3 moving averages overlaid on our chart here. Now, something to keep in mind is that the TradingView technical analysis platform in the Market Barometer here is only going to allow you to add 3 indicators at a time. But that works in our favor because, frankly, when you add too many technical indicators and oscillators all at once, not only does it muddy up your chart and make it hard to look at, but you're likely to get a ton of conflicting signals from the various indicators and oscillators. So I like to set it up with 3 indicators at a time, and I think of them as templates. So I always begin by applying this moving average setup here and starting there, because this is going to give us a good kind of bird's eye view of the price trend across various time frames, right? So we're going to get an idea of the short, intermediate, and long-term price trends. Keeping it simple like this not only helps us to kind of automate our process of performing technical analysis, but it also helps us to form very clear opinions about what's going on with price, where the most important points of support and resistance may be, and the inflection points at which we might decide to enter or exit a trade. At the end of the day, that's what we hope to gain from technical analysis. Back to our analysis, let's start by looking at the long-term trend. So we're going to lean on the 200-day simple moving average to indicate to us that long-term trend. And remember, the 200-day is the line that smooths out price the most. So you're going to see it reacting very little to short-term price fluctuations. So it's usually pretty easy to identify which line is the 200, 50, and 9-day. But in case you're having trouble with it right now, the 200-day is this one way down here. You can see it's not reacting that quickly to price, but generally the 200-day moving average is moving up and to the right. In addition, price is currently well above the 200-day moving average. So those 2 bits of information are telling us that the long-term price trend is clearly up. Next, we have the 50-day simple moving average, which is our indicator of the intermediate term trend. And again, the 50-day moving average is gonna smooth out price, not to the degree that the 200-day does, but more so than the 9-day does. So you'll find this line slowly reacting to fluctuations in price. So right now it's this middle line. And you guys can always change the color of each of these lines using the settings here, if that's going to help you keep straight which line is which. But here we have the 50-day moving average line. So with the 50-day moving average moving up and to the right, broadly the intermediate term trend is up. But you can see that the angle with which the 50-day moving average is moving up and to the right is starting to flatten out a little bit, meaning that the momentum in the intermediate term trend might be cooling off a little bit. And with price and the 9-day EMA recently dipping below the 50-day simple moving average, that tells us that the intermediate term trend is at an inflection point and might be in jeopardy of breaking down. And that leads us to the short-term trend. Now we're going to measure this at this point with the 9-day exponential moving average. And so you can see that price is below the 9-day EMA, and that price and the 9-day EMA again recently dipped below the 50-day moving average. So considering that and the fact that the 9-day EMA is angled down and to the right, it's a pretty clear indication that the short-term trend is down or in a bearish formation. Not only that, but you see price, the 9-day EMA, and the 50-day simple moving average all coiling together. Now, this is telling us that we're at a pretty major inflection point right here as far as the intermediate and short-term trends are concerned. Now, typically when you see moving averages and price coiling together like this, it means that the market is building up energy in anticipation of a move in one direction or the other. So which direction is it going to move? Well, that's the $64,000 question. And we can rely on other technical analysis indicators to help clue us in as to which direction it's likely to break, but that's another reason why it's so important, in my opinion, to perform a top-down analysis. Because the more that you form your opinion on the macroeconomic outlook, and the better you understand the fundamental value of the underlying security, the more consistent you'll be able to be in forecasting which direction these types of technical setups are likely to break out in. So definitely check out our macro and fundamental analysis crash courses to develop those skill sets as well. That said, we can also lean on some more of our technical indicators, specifically the MACD and RSI, to help us gain even more information as to which direction this type of technical setup is likely to break out in. But it's important to understand that with technical analysis, so much of this is open for interpretation, and so much of it is art as much as it is science. One person might look at this chart and, be focused on this exponential run higher here, and say to themselves that the recent move down is just this stock digesting these big gains and building up energy for another move higher. Another technical analyst might look at this chart and say, with price moving below the 9-day EMA and then the 9-day moving below the 50-day, that this is clearly about to move into a new intermediate term downtrend. Personally, I don't think we have enough information yet to make a sound judgment about how this coiling together of the moving averages and price is likely to break out yet. So let's take a look at the MACD and the RSI and see if we can get any more information that might clue us into the likely future direction of price. So I'm going to go ahead and remove the 9-day EMA. It's going to free up another indicator that we can add, and in its place I'm going to add the MACD. Now again, this is an indicator of the short-term trend and changes in that trend. So that's why I've decided to replace the 9-day EMA with the MACD, because they serve similar purposes, and having them both up there is just going to muddy our chart up. So for the sake of simplicity, we're getting rid of the 9-day EMA, we're adding the MACD. Alright, so what's the MACD telling us? Well, first and foremost, what's jumping out to me about what I'm seeing on the MACD right now is this same coiling, right? So MACD was extremely positive up here in early September and took a nosedive right along price through September. And then you can see the histogram turns negative, meaning that the MACD line crossed below the signal line. You can see that happening right here. And, so the histogram turns negative, meaning that the MACD line drops below the signal line. Then it turns positive for a second again, and then negative again. So this same coiling confirming to us that energy is building up for a bigger move higher or lower. We also get several crossovers between the MACD and the signal line. So here the MACD is crossing below the signal line. It's a bearish signal. Here we have the MACD crossing above the signal line, and then once more and most recently we have another MACD crossing below the signal line, another bearish short-term signal. So this coiling, coupled with the fact that the MACD is hanging right around that 0 level, isn't really giving us any clear bullish or bearish signals. But if I had to choose a direction one way or the other based solely on the MACD, I'd be leaning bearish, based mostly on the fact that we had that recent bearish crossover between the MACD line and the signal line, and on the relative value of the MACD being, close to 0. Next, let's take a look at the RSI. So I'm going to just get rid of the MACD here by clicking the X in the upper right of the MACD pane. Come back up to our indicators button. We're going to scroll down to relative strength index. There we are. And we get the RSI added to the bottom of our chart. Now, this is defaulted to overbought levels at 70 and oversold levels at 30. You can see that being indicated by this dotted line here. And we've also defaulted to the 14 period look back. Since we're looking at a daily chart, that 14 period look back is going to be a 14-day look back. So always important to consider what these different indicators are telling you, how they're set up, and keeping that in the back of your mind whenever you're performing analysis using them. So the RSI hovering right below 50 isn't really giving us an indication of overbought or oversold levels. So again, that's just kind of confirming the theme that we're already picking up on, that there's a lot of energy building up, and right now there's not a lot of technical information that's indicating to us that this is likely to break in one direction or the other. There weren't any obvious obvious divergences in the MACD or RSI, or really any other obvious signals that would have indicated a likely move in either direction. So when that's the case, I usually defer to the prevailing long-term trend. This chart is clearly still in a long-term uptrend, as demonstrated by the 200-day moving average moving up and to the right, and by the fact that price is well above the 200-day moving average. So if I had to put my money on a move in either direction, I'd say that there's a higher probability that the long-term uptrend will continue. But so much of the action that you might take based on the technical analysis that we just performed is going to be dependent on your style of trading and the time frame that you're working with. If you were looking to put on an extremely short-term trade, I'd say that the short-term trend is bearish, and I'd be looking to put on a bearish trade. If you were looking to put on a position in the intermediate term, like say 30 days to a few months in length, I'd say you didn't have a very high probability choosing a direction one way or the other in that time frame. But again, if I had to choose one direction or the other in the intermediate term, I'd probably just defer to the existing upward trend on that time frame. Advanced chartists might look at this chart and see a symmetrical triangle developing. Now, a symmetrical triangle is a chart pattern that in this context would typically lead to a continuation of the existing uptrend. If you want to learn more about triangles and other chart patterns, stay tuned for some of our more advanced tutorials on technical analysis in the future. If you're looking to put on a long-term trade, I'd say that, the price is more likely to continue its move up, but that this probably isn't the best entry point for a long-term trade. Now, that could be argued. The move back down to the 50-day makes it more attractive than it was, 2 months ago in the beginning of September, absolutely. But price is still relatively high compared to the 200-day moving average. The stock is trading at about $115 right now. The 200-day moving average is all the way down at $90. So that's like a 25-point move down before price would even reach that 200-day moving average. And who's to say if price did get down that far that it would find the 200-day moving average as support? But that said, looking back to March, you can see price did move down to the 200-day moving average, even dipped below it for a few days there, and that ended up being a very attractive entry point for a long-term position. Now, it reached down to that level during the depths of the COVID-19 pandemic fallout. Now, Apple's obviously a stalwart and a major company here in the United States and in the world, really. So it's going to be pretty rare that in a prevailing bull market that a big company like Apple reaches down to its 200-day moving average. But if at that time you could have put the fear of the COVID-19 pandemic aside and realized that, Apple, the company and the brand still had a ton of value, that this price reaction to the COVID-19 pandemic was probably overdone, and price reaching down to its 200-day moving average in late March would have been an extremely attractive entry point for a long-term position. And had you performed some fundamental analysis of Apple around that time and realized that it was still a very strong, financially sound company that wasn't likely to go anywhere anytime soon, might have given you the confidence that you needed to enter a new long-term position, even though the macroeconomic outlook at that time was a little unclear because of all the confusion created by the COVID-19 pandemic. And that's just another example of why it's so important to perform macro and fundamental analysis in addition to your technical analysis, because each of them gives you a different piece of the puzzle, and they work hand in hand to help you make smarter investment decisions. There you go, folks, a full rundown technical analysis example of Apple stock. We talked about the prevailing price trend, about areas of support and resistance. We looked at the formation of the moving averages. We also talked about the short-term price momentum by way of the MACD and RSI. All of these pieces of information helping us get a picture of the technical setup, the price performance, and likely future course of the stock price for Apple. Now, when we use all this information in combination with the analysis that we're performing at the macroeconomic and fundamental levels, all of a sudden we have an extremely powerful toolbox, a set of techniques that's going to help us to make smarter investment decisions and to consistently grow our wealth over time in the financial markets. So if you guys like this video, don't forget to subscribe to the channel, hit that like button, comments down below. Don't forget to check out our other free crash course tutorial series over at marketbarometrix.com. And until next time, thanks for tuning in. We'll see you guys in the next video.